Financial planning for couples is more than just managing money. It's about building a shared vision for the future. Whether you're newly married, in a long-term relationship, or preparing for major life milestones, aligning your financial goals is essential for long-term success. When both partners understand each other's values, spending habits, and priorities, it becomes easier to make decisions that support the relationship rather than create conflict. When couples commit to transparency and teamwork, they can avoid common money struggles that cause stress in relationships. Mutual trust grows when both partners are involved in money decisions and understand how each choice affects their shared future. With consistent planning and smart money habits, couples can build wealth together, prepare for unexpected challenges, and achieve goals such as buying a home, raising a family, traveling, or retiring comfortably. Financial planning isn't just about numbers, it's an investment in your relationship. When you and your partner manage money as a team, you create stability, deepen trust, and build the confidence to tackle any future milestone together. Merging finances as a couple is an important milestone that can strengthen trust and create a secure financial future together. Combining money can feel overwhelming at first, but with the right communication and planning, the transition becomes smooth and empowering. The process begins with complete transparency. Both partners should openly discuss income, debts, savings, credit scores, and recurring expenses. This honesty builds trust and prevents misunderstandings later. It's also important to talk about financial habits, because one person may be more frugal while the other prefers spending more freely. Understanding these tendencies helps you create a financial system that respects both perspectives. Couples can combine finances in different ways, and choosing the right method depends on what feels fair and comfortable. Some fully merge all their accounts, while others prefer a hybrid approach that includes both joint and individual accounts. A shared account can cover household bills like rent, utilities, and groceries, while individual accounts allow personal independence. Decide together how much each person will contribute to shared expenses. Whether you prefer equal contributions or proportional contributions based on income, the most important thing is ensuring the system feels fair to both partners. Establishing clear financial roles can streamline money management. Decide who will handle bill payments, monitor expenses, track savings, or communicate with service providers. Even if one person manages the logistics, both partners should stay involved by reviewing statements and discussing financial decisions regularly. Setting shared financial goals strengthens teamwork. Whether you're saving for a home, preparing for children, planning a major purchase, or building an emergency fund, setting goals creates clear direction and mutual motivation. Break each goal into simple milestones so progress feels achievable. Daily spending becomes easier to manage when both partners understand their combined expenses. Look for ways to cut costs and avoid unnecessary spending. Even small adjustments, like meal planning or reducing impulse purchases, help free up money for savings or debt repayment. Credit scores also play a big role in your long-term plans, so review and improve them together through consistent payments and lower debt levels. Build an emergency fund with at least 3 to 6 months of expenses to protect your household from unexpected financial stress. With openness, shared decision-making, and teamwork, merging finances becomes a smooth and positive experience. Budgeting as a team is another essential part of building financial harmony. Start by understanding your combined income and listing all recurring expenses. Separate essentials from non-essentials so you know where your money is going each month. Discuss your financial priorities and consider each partner's goals, such as saving for a home, investing, or keeping space for personal spending. Clear communication prevents misunderstandings and ensures your budget supports both people's needs. Choose a budgeting method that works for your lifestyle. Some couples prefer structured frameworks, while others rely on budgeting apps that track spending and automate parts of the process. Balancing shared and personal spending is important for maintaining independence. You can handle household expenses together but still allow space for each person to enjoy personal purchases without conflict. Make it a habit to review your budget regularly. As expenses change, adjust your plan so it stays relevant and fair. Creating monthly financial check-ins or money dates helps you stay aligned, track progress, and celebrate small wins together. Turning budgeting into a shared ritual strengthens communication and connection. Saving for major shared goals like buying a home, having children, or planning for retirement requires intentional planning. When saving for a home, start by discussing where you want to live and what type of property fits your lifestyle. Identify how much you need for a down payment, closing costs, and potential renovations. Use high-yield savings accounts to accelerate growth and explore programs designed for first-time homebuyers. When planning for children, consider both immediate costs like childcare and long-term expenses such as education. Open dedicated savings accounts or education funds to begin preparing early. Planning for retirement should be a long-term commitment. Estimate future expenses and use employer-sponsored retirement plans or IRAs to build a strong foundation. Regularly review contributions and adjust them as your income increases. Automation is one of the best tools couples can use to stay consistent. Set automatic transfers for savings goals and automate bill payments to prevent missed deadlines and reduce stress. Schedule regular financial reviews to assess your progress and make adjustments as needed. Staying informed about economic changes, interest rates, and financial opportunities helps ensure your plans remain effective and up to date. Debt is one of the biggest financial challenges couples face, but addressing it together can reduce stress and strengthen your relationship. Begin by listing all debts, including balances, interest rates, and minimum payments. Understanding the full picture helps you create a structured plan. Discuss how each partner feels about debt. Some people want to eliminate debt aggressively, while others take a more gradual approach. Choosing a repayment strategy together builds alignment and reduces conflict. You can use methods like the avalanche method, which targets high-interest debts first to save money over time, or the snowball method, which focuses on paying smaller debts first to build momentum. Some couples combine both strategies depending on their goals. Make it a priority to communicate openly about your debt repayment plan. Avoid blame and focus on solutions and next steps. Schedule monthly reviews to track progress, update your plan, and celebrate achievements. Use digital tools to make repayment easier. Apps can help track balances, send reminders, and visualize your progress. If debt feels overwhelming, professional help from nonprofit credit counseling agencies can provide guidance, reduce interest rates, or help consolidate payments. Preventing new debt is just as important as paying off existing debt. Build an emergency fund to avoid relying on credit during unexpected events. Discuss major purchases together to ensure they align with your goals and budget. Celebrate milestones throughout your debt-free journey. Whether paying off a credit card or hitting a savings target, recognizing progress keeps you motivated and strengthens your partnership. If this video helped you understand accounting a little better, don't forget to like, share, subscribe, and turn on notifications for more accounting tips and guides.